Hello. This is Camilo, and I comment on matters finance, investment, and the economy at large, basically helping individuals make better economic decisions. I'm a firm believer of financial literacy would grow financial inclusion where we have everybody financially included. Basically, from a point of no, individuals are better in a position to access and also utilize or use financial product and services to better the financial outcome. So the CBK, that is Central Bank of Kenya, the physical agent of the government of Kenya, advertised some bonds. That was yesterday, and the purpose of this video is to do an interpretation of these prospectuses. Now we want to help individuals. When you find something like this, what does it mean, or what does it entail, and how can you take advantage of these investment opportunities? So we'll just go directly to that. We'll say it is a prospectus for reopened 10-year, 15-year, and a new 25-year fixed coupon treasury bond. And gladly, our capital market is vibrant. You can find in this October sale, in one offering, there are 3 bonds to choose from. And this brings variety. There's a bond for 10 years, 15 years, and another one 25 years. Though the 10-year and 15-year bond are reopened, so there has less period remaining. But a variety, as I was saying, to help individuals who might want to go for a short-term bond or a long-term bond. In one offering, they have this opportunity to do so. So thereafter is what they call fixed coupon treasury bonds, and the fixed coupon treasury bonds, in short, is to mean that the interest rate that you will be agreed upon the starting of this bond or at auction will be fixed up to the end of the period or the tenure of that bond. In advanced economies, like in the US, we have different type of bonds rather than what we have locally. In the US, you'll find bonds that are indexed to inflation, where you find a bond will fluctuate as the interest rate or the coupon on the bond will fluctuate as the inflation link rise or goes low. The coupon rate on the bond is indexed on the same, but this is different. Ours is different. This is fixed. It is you are earning a fixed rate of return up to the end of the bond or the tenure of the bond. Next, there are some codes there that identify a bond. Our board 1 is a FXD1 2027 of 10 years, 2017 of 10 years. So basically, the year shows the 2017 is when this bond was first issued. The stroke 10, this is the tenure of that bond. When it was first issued, it was meant to last for 10 years. Then we have the next one, that is FXD1 2020. This bond was issued in 2020, being reopened now in 2022, and it was a 15-year bond. And there is now the new issue, that is FXD1 stroke 2022. The period is 25 years. So CBK is looking to raise 40 billion in the 2 reopened bonds and 20 billion in the new issue, that is the 25-year bond. And then they have what they call October 2022, or what we fondly refer to as October sale. When you hear me mention October sale or September sale, these are the bonds that have been offered on a respective month. Gladly, they advertised these bonds way back or way before. We are in it. These bonds were advertised on 21st of September. That was yesterday, and this is meant to give investors an opportunity to maybe mop up their finances and get ready for the auction, which will be happening by by October. That should be around 10th, and another one 24th of October. So within now and then, one should be applying and also mopping finances to be able to get into that. There is another part of the page one where we have the yield to maturity of the truly opened bonds. That is the FXD1 2017 stroke 10 and FXD1 2022 stroke 15. So the yield to maturity, I fondly explain this by saying that when CBK is offering the reopened bonds, they try as much as that the offer price that will be agreed upon by at the auction will match the price in the secondary market. If you have been following my post, you know that bonds, securities, what we call securities, are tradable in the secondary market. That is the NSE, Nairobi Stock Securities Exchange. So at the market, there are several factors that will affect the price of a bond, and not limited to the rates of inflation, the rates of real interest rates, and everything. So when the CBK is opening a bond, the intention is that the yield should match the secondary market yield, and that is why they have the yield to maturity listed here as a guidance on the clean price at a certain yield. So by the time we are we are auctioning these bonds at the date of auction or the value date, these bonds should, the yield should match what is in the secondary market. Let's jump to the second page, and maybe someone would be kind enough to tell me whether I'm audible enough. Maybe a comment to the service, or I'm too fast, or I would appreciate a feedback. So page 2 of our prospectus, this is now where the terms and conditions of every bond is listed, and we'll start by identifying the bonds. That is as we had identified these codes for the 3 bonds, and then we'll start with an invitation. A prospectus is an invite to invest. So it is CBK acting on behalf of the GOK, that is the government of Kenya, inviting every person in the republic, investors, be they institutional investors or private investors, to invest in these bonds, and then the terms and conditions for the bonds have been listed there. So the issuer is the Republic of Kenya. CBK is just an agent or a physical agent. They are the bank of the government. And then there is the amount. What money do they intend to raise? We have already said that is 40 billion for the truly opened bonds, and then 20 B for the new issue. And the next item is the purpose. These money are being raised for budgetary support, and had this been an infrastructure bond, the purpose would have led infrastructure projects. So the ordinary bonds are raised for budgetary support, whereas bonds to fund infrastructure projects are well, what we call infrastructure bonds, and the purpose will be noted there. So something to note here is that these ordinary bonds, which are used to fund ordinary budgetary support, these come with the tax element, whereas the infrastructure bonds, which fund infrastructure projects, come as tax exempt. After that, there is the tenure for the bonds, and we have started by saying the 2017 bond had a tenure of 10 years, though that bond has been in the market for quite some time, and now it has around 4.9 years remaining, and the 2020 bond has around 12.5 years remaining, and then the 2022 bond, now the new issue, will run for 25 years. That tenure is what I refer to as a period from you invest, maybe the 2022 bond, you invest today, the value date will be, that is October, when the auction and then settlement happens. So that is when the value date starts, and it runs up to after 25 years. This is when you receive back your money. So a point of clarification here, that if you are going for a reopened bond, you won't invest for 10 years. For example, for the 2017 bond, you won't go for the 10 years. You will go for the remaining period. So let that be understood. We go back to our prospectus, and the other item is the coupon rate. When the two reopened bonds were first offered, their first auction, the coupon rate was decided upon when at that auction. In 2017, an auction happened and the coupon rate was decided upon. So for the 2017/10 bond, the coupon rate is 12.966%. So when you are going in for that bond, you know what to expect. Unlike the new issue, which is the FXD1 2022/25, this bond will come with the coupon rate will be market determined. It is its first time to be offered, and auction will have to happen, and then investors on the auction committee, that's a function of CBK, will agree upon the coupon rate, or what investors will earn from this bond. Moving on, that is the period of sale. So we have already said the bonds are up to be for investors to apply from today, and then the deadlines are as indicated there. When your last date for applying for these bonds, that should be October, said October 4th for FXD 2017-2010 and FXD1 2020/15, and then on 18th October the period of sale for the 25-year the new issue bond lapse. So let's go to the next item on that prospectus. That should be the value date. Please note that on the value date, this is when you are supposed to pay for your bonds. If you don't pay by this date, that is the value date, you will be closed out from paying for the same. So the value date is important to note. For the new issue, the value date is when we start calculating the next interest payment date. This is unlike the reopened bonds. The value date was agreed when this auction or for these bonds happened. But for the new issue, the value date is when we'll start calculating the next interest payment date. So we'll go to the next item on this prospectus, and that should be the price quote. And when we talk about the quote, you can get price at a discount, you can get price at a premium, and you can get price at. So this is what is happening when we are bidding. We have already said that the market factors will affect the yield, and the yield will, the CBK will try as much as possible that the offer price matches the market yield. So if you pay more than 100%, 1 unit of a bond costs 100 shillings. If you pay more than 100 shillings, this is what we are calling at premium. You are paying in excess. If you are paying less than 100 shillings, you are paying at a discount. But if you are paying 100 shillings for the opened bonds, you are getting all the new offers. You are getting this bond at par. So for someone maybe going bidding for 100,000 and receiving a message to pay maybe 101,000, these will tell you there are factors that have come in, and one of the issues would be the price when the price is calculated. Now, something to note: if you get a bond at a discount, then you will be forced to pay tax on that discount. So when you'll be settling for the allocated bonds, one factor you have to consider is if you get the price at a discount, you will be charged tax at that. Though it will always be less than 100 shillings because we have agreed that you are getting it at a discount. From there, we want to look at the next item on the prospectus, and that should be the minimum investable amount. And previously we have said that the minimum amount you can invest in these, what I'm calling ordinary bonds, is 50,000. Had this been an infrastructure bond, the minimum amount you can invest is 100,000. So what is happening is we want more and more of private investors or small-scale investors taking these investment opportunities, and that is why you find the minimum amount being 50,000. For someone who looks at this figure from a point of what they will earn, they might lose the big picture. Because for some small-time investors who started the newbies, the strategy where people take is I'm not able to raise a million or two or three, but I can be able to raise maybe 100,000 or 50,000 every 3 months. So the target is always every 3 months I'm getting a bond. Every 3 months I'm getting a bond, and I'm building a portfolio. Within 2 years, the strategy will have worked that you can have your desired size of the portfolio. Maybe we are saying you want a target of 2 million. So you can be getting every 3 months, you get a 50,000 bond. Every 3 months, you get another one for 100,000. So that works very well. It has worked for so many people. Then we'll go to the next item there, that is the interest payment dates. The beauty with these government securities is they are predictable. You know when to expect your returns next. So basically what is happening is, for example, the FXD1 2017 stroke 2020, the next interest payment date is on January, that is the 23rd of January. So when you invest in these kind of securities, what you have in mind is, I know when to expect coupons or interest. when am I receiving my money back. And when you look at the interest payment dates, you'll find that they have an interval of 6 months. Basically, treasury bonds pay interest every 6 months. So if you got, let's say at auction, you got an interest rate of 10% on a certain bond, what will happen is they will split. What you were supposed to earn, maybe you are supposed to earn 10,000, will be split, and every month you'll be, every 6 months you'll be earning 5,000. Every 6 months you are earning 5,000. So this becomes ideal for planning purposes. Uh, Someone will say to remain liquid throughout the year. So they split their bonds. January they get a bond, February they get a bond, March they get a bond. What will happen is when the interest starts coming, every 6 months, one is receiving something. And this makes that aspect of liquidity, of being liquid every throughout the year, very possible. Um, let's go to the actual, and something to add there, that the interest payment dates help us in generating what we call a coupon schedule. A coupon schedule is a guide on what you expect to earn and when you expect this money. Something simple that I had generated for the purpose of this session is a coupon schedule for the FXD1 2017 stroke 10 years. And we have already said that this bond has 10 years remaining to maturity. So that is 5 years remaining to maturity. 5 years have lapsed since 2017 to 2022, and then the 5 years from 2022 to 2027 when this bond will mature. So a coupon schedule looks will tell you the bond. It will tell you the face value. This will help us in calculating what you expect, and then the tax element for these bonds, and then the coupon rate, the value date, and the maturity date. So as I was saying, the interest payment dates become very important for you for planning purposes. Like for our bond here, on that is on January 2023, one is expecting 29,000, where they had, if one had invested a face value of 500,000. On July 23rd, one is expecting some 29,173. This is net of the tax amount. So that is how a coupon schedule will look like. It will tell you the total coupons you will earn from this bond, and then the coupon plus principal, that whatever you will receive at the end. So the gross for total coupons on this bond is around 324,150. Then you less the tax, you will have earned around 291,735. So the coupon plus principal, the total, that should be around 791. Coupon schedule becomes important where you can compare the earnings from one type of investment, take for example real estate, and then now here we have another type of investment, which is a bond, and you'll be able to compare and be able to say which is the better investment. Or what we are talking about is appraisal when you have two kind of investments. So this coupon schedule should be able to help you when you are doing that. Let's take a gulp of water. Moving on, the next item on our prospectus is the taxation element, and for tax on bonds, any bond with a period, a tenure of 10 or more years, you will pay tax, withholding tax at a rate of 10%. For any bond with a tenure less than 10 years, you will pay tax at a rate of 15%. Infrastructure bonds, I have already said that these are tax exempt. You won't pay tax on those. And it makes the infrastructure bond very attractive. So basically, what happens with this withholding tax is KRA requires CBK to deduct tax when they are paying you interest and submit on your behalf. So it is not you who is accounting for this tax or paying this tax. This tax is already charged at source. That is why we call it withholding tax. We'll have some tax trainings as we go on for people to understand the different aspects of tax on their investments. So we have on for a bond more than 10 years, 10 or more years, taxation is at. For a bond less than 10 years, taxation is 10%. But when you get an infrastructure bond, that is free. The next item on our prospectus, that should be the redemption date. We have said that the good thing with bonds is they are predictable. You know when to expect your interest, and you know when to expect your principal back. So on this, the redemption structure for these bonds is that they will run up to the end. That is maybe for the 10-year bond, when it elapses, that period elapses, you get your money on the specific date. For the 15-year bond, same thing, and the 2022 bond, the new offer, which is running for 25 years, the same case. You know when to expect your money. That is the redemption. The redemption structure varies from bond to bond. So you don't just go in and say, I'm expecting money after maybe 25 years. These are terms and conditions that differ from one bond to another. So it would make sense to be checking through these prospectus, because once there's an infrastructure bond, I will be here to review it, and you will find a different redemption structure. This bond, the redemption structure, is receiving back the full amount at the end of the tenure. We have other bonds which are paying 50% of the invested amount maybe halfway through the bond. So these are also changes a couple of things. So but for these specific bonds, they are running up to maturity. This is when you expect full principal. If you would decide to hold these bonds up to maturity, let me put that caveat, because you can choose not to wait up to maturity, where we will be looking at the options that you have. Then from there is the issuing and agent, that is who are issuing this on behalf of the government, and they are the placing agent, the paying agent. Then placing agents. Through these, what we call financial intermediaries, who are licensed, be it licensed investment advisors, licensed investment bankers, financial non-bank institutions, banks, licensed stock brokers, apply for these bonds. You can apply for these bonds. To pick the placing agent with another prospectus, which is the commission. So the commission, is the commission. I'll back to the other item on is issue. When you are bidding, you choose to go for competitive bidding. I choose to go for non-competitive bidding. you receive or we both go for competitive bidding, and you receive a price which varies to mine, because when you bid, you're asking for your own your desired rate of return, or what you would want to earn from this bond. That is more auction. And next we want to talk about prospectus, which is non-competitive bids. Now, before I talk about that item of the non-competitive bids, or the item on the prospectus, I also want to differentiate between competitive bidding and non-competitive bidding, because moving on, we'll be using these terms so much. So when I'm applying for these bonds on offer, I have an option to saying my desired rate of return. I'm going for the 2022 new issue, which has a tenure of 25. I'll say I need maybe, for example, 13.29% as my rate of return. On the other hand, someone there who chooses to go for competitive bidding, and they say their desired rate of return is 13.2. This is competitive bidding. And this is left to some institutional investors, and also for people who know how to bid, someone with experience in these capital markets. But if you are a new entrant, you are new in the capital markets, you don't know how to go about bidding, and you don't want to bid something way above that, you are locked out of the bidding. You have an option for non-competitive bids, placing an uncompetitive bid. This is where when you are applying, when you are asked your interest rate, you indicate 0 for non-competitive bidding. What will happen? I can explain the auction process briefly. What will happen is, at auction, the auction committee will take all these competitive bids, and they will agree on a cutoff point. There are so many issues to do with inflation and the economy and what the government is willing to pay. And then when they have agreed on the cutoff point, they will accept all competitive bids within the cutoff point, and then reject the bids which are outside the cutoff point. So if you had placed a competitive bid, now be pray that yours is within the cutoff point. Then what will happen after they have done the cutoff? They will take the competitive bids within the cutoff point, and they will do a weighted average. And the rate after the weighted average is what is allocated to all non-competitive bidders. For new entrants, I always advise that they go for non-competitive bidding, because rarely will you ever find that the average rate that has been allocated for non-competitive bidders will not vary so much from what competitive bidders got. So you are lucky go for getting this competitive bid. But if you know how the capital markets work, then you can choose to go for competitive bidding. In upcoming sessions, we'll be looking at how can one bid competitively and get value for their money and everything. Now, going back to the prospectus, we have that item, non-competitive bids. So if you are going for non-competitive bids, you have a maximum. So if you choose to go for competitive bidding, just know that there is a maximum of what you can go to. Then bid closure, and when okay, expects your bid, and if you are within the country or you are outside the country where you can roam, just place your bid through TMD, that is Treasury Mobile Direct. If you are outside the country and you are not able to loan, you cannot access your phone number registered with the Treasury Mobile Direct, then and you want to participate, you can write an email to CBK. I will be sharing the email in the comment section of these posts. And if you and there are deadlines for submitting your bonds that for the two reopened bonds, the deadline is 4th of October. And for the 2022, the new issue, the deadline is on 18th of October. The auction dates, this is when the auction committee, a function of central bank, will sit down and do all what pertains to the auction process. Thereafter, after that item, we can go to, let me switch to that. We can go to the results. And the investors should obtain details of the amounts payable for successful bids from central bank on 6th of October and 21st of October. So if you are loaning or you are within the country, you are within the network, you will receive a text message if you had participated in these bonds, in the bidding for these bonds. You will receive a text message informing you of the success or success of the bid that was applied, of the bond that we applied. And in this message is what we would commonly refer to as a bidder's report. So now from now onwards, when I talk about a bidder's report, just know it is that text message that you receive from CBK informing you that your bond was successful and some other issues that I'll be touching upon. So, but if you don't receive this message and you had participated, it will make sense to call CBK, or if you're outside the country, write an email to CBK requesting for a bidder's report. For example, if you're outside the country and you're not roaming, write an email to CBK and request for a bidder's report, because you don't want to be late for the date of paying. There is a deadline, and if you allocated bids, a board for your successful bid, then be sure to pay it on time, lest you are blacklisted. Let me touch what I was talking about, the bidder's report. This is a text message or an email which will inform you of the success, that your bid was successful, and then they will inform you the amount that you're supposed to pay. When you were applying, you indicated the face value, maybe 100,000, but the amount payable might not always be the face value, because as we said, that prices will always differ. Someone will get price at a discount, another person will get price at premium or at par. And especially when we are talking of reopened bonds, there is the issue of accrued interest, which I'll be explaining in another session. So just be sure to pay what is indicated in the bidder's report. And then in the bidder's report, there's something else important, which is the reference. This is what you quote when you are paying for your allocated bonds. It will be a number left and then a couple of numbers, 6, 7, 8, 9, 1, 0. And this reference, you will use it to, let's say we are doing an LTGS. I'll have done a session on how to transfer money via LTGS on your mobile, on your internet banking platform. You don't always have to go to the bank. But if you also have to go to the bank, when you are filling in the form, this reference that comes in the bidder's report, that message is so important. Is what you quote where the purpose of funds. When we are transferring funds, you'll find being asked for the purpose of fund. That is what you quote there, because that is what CBK will use to pay for that, to know what the amount, but the money you are paying for. You will find a seasoned investor going has a bond and a treasury bill that they are paying for in the same time. So the reference becomes important to be able to differentiate these payments. I've already said defaulters will be blacklisted. Graciously, they are giving people like three options, three chances. So if you default once, don't, but have a genuine reason. You don't want to apply for a bond that you don't want to pay. We have said these bonds have opened yesterday. You have all the way to next month, so be prepared. But if something happens and you are not able to pay on time, then you can choose to call CBK or email them and explain them to them. What you just want to be is you want to be safe. You'll be given around three chances before they blacklist your CDS account. I had already mentioned commission. This is for placing agents. So if a bank is selling these bonds on behalf or helping individual apply for these bonds on behalf of CBK, they will earn a commission. Then let's talk about rediscounting. Is another item on our prospectus. So when we talk of rediscounting, is when you want to when we talk of rediscounting is when you want to check out before maturity of your bond. What if you want your money back before maturity? If I pick this bond for 25 years, am I stuck with it up to the 25 years have lapsed? No. You can rediscount or you can ask your money back. And you have two options. We'll start with option one, which is recommended. Option two is a last resort. Option one is selling your bond in the secondary market. We have said that these are tradable securities. They can be exchanged in the securities exchange. And gladly, ours is a very vibrant secondary market, especially the board counter. We have the board counter trading billions of money every day. So if you want to sell your bond in the secondary market, you just need to talk with with a broker, and they will initiate that process. You will fill in some form which will be delivered to CBK, and the process of selling, getting as a buyer for your bond will start in earnest. So it is easy if you want your money back. Maybe even you get a bond today and you want to sell it in a week or two. This is just okay. For people who know how to trade or how the market operates, we call them board traders. They will get a bond, an attractive bond, go for an aggressive uh, competitive bidding, and then get a bond with a very good return. And what they want to do is they want to dispense this bond as soon as possible, so that they can get their money back and do something else with it. So that is option one. If you want your money back, you can have your money your bond sold at the NSE. And what I would want to highlight at the moment is at the NSC, earlier on, we had what we call odd lots, lots with 50 million and below. That has not been very active. So you would find if you're selling a bond with less than 50 million, you'll find earlier on we had difficulty selling those kind of bonds in the market. But currently and at the moment, with a couple of people in the financial literacy space, they have been educating individuals, and what we have found is these odd lots, they have become active. Like if you look at the market report for yesterday, you'll find bonds with the values of 100,000, 200,000 trading in the market. So basically you don't have a reason not to, based on the long period. You can choose to go for, you can choose to get the bond, and then 2 years down the line you can sell your bond. That is number one, how you can rediscount your bond. Number two, as a last resort, if your bond does not get a buyer from the secondary market, then the secondary market participant, be it an investment broker or whatever, they will write a note to CBK informing CBK that they have tried, and this bond, there's no buyer of this bond in the market. If you as know, they have not been able to secure a buyer in the market. And what will happen is CBK will discount the bonds as a last resort at 3% above the prevailing market yield or coupon rate, whichever is high, upon written confirmation to do so from the Nairobi Securities Exchange. We want a vibrant uh, securities exchange market. We'll be talking about the importance of a securities exchange market in an economy, and its role in helping people raise funds. These institutions, be they government institution or companies, raise funds. So having a vibrant market is good. So what CBK is basically doing is, instead of going to them to rediscount your bond, sell your bond in the Nairobi Securities Exchange. And let me put it here that the process of selling your bond or buying a bond from the secondary market is so secure because CBK will have to get some forms which you have signed to be able to allow the transfer of this bond from your CDS account to the other CDS account, maybe of the buyer or the seller. That process is controlled through a system by CBK. So you are safe, you won't lose your money. A couple of people have been concerned about, I'm dealing with a broker, I'm dealing with, and I might lose on my money or lose my bond. But don't worry, none. This is a secure process which CBK is in the loop. Actually, this bond is not given to a broker. This bond is transferred from your CDS account to the buyer, or from the seller account to the buyer account. The other item in the prospectus, is liquidity. Though this item doesn't really matter to the private investors or individuals, because this is concerning banks. That is concerning banks, and they are reporting to CBK. Listing, these bonds will be listed in the Nairobi Securities Exchange. They are tradable. Classification, they are benchmark boards. That those are some terminologies within CBK. And then eligibility of people who can invest in these bonds. So investors who have an active CDS account with the central bank are eligible to apply for these bonds. I will briefly talk about opening a CDS account by the end of this if one doesn't have a CDS account. And reopening, the bonds can be reopened at a future date. So same case applied. In 2017, they issued a bond, and now they are reopening this bond for people to when they are trying to raise more money. So the bonds too can also be opened at a later date, at a future date. Secondary trading on the bonds, which will be in multiples of 50, will commence on Wednesday 12th and Tuesday 25th. These are the two bonds, the reopened bonds. The commencement of trading will be on 12th, and then on 25th of October. Now the new issue, the 25-year bond, can be traded then. A little break didn't hurt anyone. Then from there is CBK is saying they have the right to accept or reject without giving any reason. What happens is you might find someone has applied for a bond, maybe 5 million. They can accept fully or part. They can accept 2 million and reject 3 million without giving a reason. Though with the cash clash, you don't expect this to happen. There are a couple of the government is struggling to raise funds. So that brings us to the end of the prospectus. Uh, for you to invest with the government or now purchase these bonds or treasury bills, you need to have an active CDS account. And the process of opening a CDS account, in brief, without going to the unnecessary too many words, you need your KLA PIN, your identification document, that is an ID or passport, and then you need a bank account with a Kenyan bank. And what you will do is walk to any CBK branch. If you're in Nairobi, go to head office. If you're in Nyeri, if you're in Nakuru, Kisumu, there are branches in Mombasa, everywhere. Then what you will ask for is a mandate card. Get your mandate card and walk to your banker. Maybe you bank with KCB or Liquidity. Walk to any branch and tell them you want them to certify that you have an account with them. There's a portion where you will fill in your bank account, held at which bank, branch, and everything. Then this is where your bank will certify by way of signing and stamping that this account, yes, is held here. Then you will fill in the other details. There's another form for TMD also, Treasury Mobile Direct. When you are done with filling these forms, you take them back to CBK. There are a couple of places you'll be expected to sign physically at when an official of CBK is witnessing this. And you give it a couple of working days and your CDS account is ready. From there, you might not ever need to go to CBK, because to apply for your bonds, now you apply that through the Treasury Mobile Direct mobile platform. When you open your CDS account, you'll be given a sheet of paper with instructions on how to apply for your bond. So it is pretty easy to use for anyone who has been using USSD codes to purchase airtime or do whatever. They can access this. Though in an upcoming session, I'll be showing how to apply for these bonds. I'll be creating some content on the same to help individuals do this. That should mark the end of our session. For more on bonds, I did a presentation on everything you need to know about bonds. Paying for your allocated bonds, applying for your allocated bonds, opening a CDS account, and everything. For more on that, in my YouTube channel, I have done a good presentation to help you get to the nitty-gritties of that. Also done a session on the frequently asked questions in regards to investing in government securities. Please do check. All those videos are up in my YouTube channel. So we will come to the end of that, and maybe we leave with a question and asking. For around 500 investing 500 and earning around 58,000, is it literal or more? What is your thought? My name is Wakamilo. I'm grateful to be doing this here. Let's get more and more financially literate, and also let's get more and more financially included. Thank you. That should mark the end of our session.